Hi, my name is Steve Beck. I'm here to introduce asset valuations to you today. I'm a chartered financial analyst, a certified insolvency and restructuring analyst, and a hedge fund manager. I've been actively involved in the markets for many years. And so let's dive right into asset valuation. The first thing we're going to do is just have a look at the history of asset valuation. Graham and Dodd, the forefathers really of everything that we needed to learn, showed that the markets are structured. There needs to be some due diligence and serious study involved in trying to determine which assets are over or undervalued. Next, we have John Burr Williams. He really pioneered the dividend discount model, showing that the discounted cash flow streams could analyze and show you which stocks, bonds, etc. are undervalued or overvalued. So between the Graham and Dodd, which really is the Warren Buffett style of investment. Warren actually studied under Graham and Dodd. And then you've got the Williams. Between the three of them, they pioneered the dividend discount model, the structured equity analysis of the markets. Well, the problem that occurred was the Nifty 50, which really was, back in the old days, the stock market bubble, where you had the top 50 stocks in the market that were really generating supremely high price-to-earnings ratios and just continuing to spiral ever upwards. So people really took a look at the Graham and Dodd model and methodology and the Williams methodology and said, does this really pertain to today's stocks, much like we did in the 2000 era? So along came Markowitz, and he really developed the diversification model to try and diversify away some of the risks. And then stepped in Sharp, who really pioneered the risk-reward ratios. So you invested in stocks, you had some form of risk which you could potentially quantify, and with that you got a potential reward or upside for taking on more risk. So at this point we then diversified our portfolios, and of course we analyzed the risk-reward payoffs through the Sharp ratio, and these 5 individuals really are the core concept of the whole CFA program. So let's have a look at some of the methodologies associated with analyzing assets. The first one we've got is the dividend discount model, which is really one of the core methodologies. It's an expected price-to-earnings ratios related to a single-stage dividend discount model. You have the expected growth rates, really, that you use based on historical rates. The same can really be applied to the free cash flow model. Both of these are projections. You're trying to project future cash flows, discount them back to present values. A third methodology that we often use is the market multiples approach. The market multiples, you really go out into the market, try and find comparable companies, and then use the ratios of those companies to apply to your underlying stock to determine the over or undervalued nature of the company. And then finally, we look at residual income, which is really your economic value added methodologies, where there's a piece of income that's attributed just to the excess or the value that's added by management to the company. So what you have in the residual income methodology, of course, is you have your economic value added, i.e. you've paid your cost of debt, you've paid your cost of equity, and there's a residual value there, and that residual is discounted back, giving you a residual income value. So in the residual income methodology, as long as your net present value is positive, then you would take on the project, and of course at that point you'd be generating your residual income. There is a final methodology that we won't be addressing, and that's the cost approach. Typically that's not done in this type of valuation. You would limit that to companies that have highly intensive capital goods, but for this study we won't bother with that. So let's have a look at asset valuation, which is really the present value of all the discounted cash flows that will flow to your equity holders. That could be in the form of dividends, could be in the form of free cash flows. Remember, though, of course, that free cash flows aren't paid to your stockholder, but that can often be used as a method of what dividends are going to be or could potentially be paid by the company. So the dividend discount model, the free cash flow model, are cash flows that flow directly to the shareholder, and that's what we're going to use as a proxy of value. Because ultimately, if you're buying a share of the company, what are you really buying? You're buying a share in those cash flows. So by discounting those back to present value, ultimately what you have is the value of holding the stock into perpetuity. Okay, so this is all very good and well. We're doing this dividend discount model. We're discounting it back. We're finding the asset values. What are some of the uses? Of course, the major use from you and my perspective is let's make money in the stock market. Let's see what's overvalued, what's undervalued. There's, of course, the analysts who go out there. They try and provide us with some input. Let's buy stocks when the NASDAQ's at 5,500, and let's sell them when the NASDAQ's at 900. No, seriously. Although there were a lot of buy and sell recommendations at the wrong sides of the market, we've tried to weed a lot of that out. But ultimately, the analyst's job is to try and determine when the stocks are over or undervalued. What you can also do is in the private equity side of the world, there's business analysts, there's business valuation people that try and give the business owner an idea of what the value of his company is. What we'll do there is we'll use the dividend discount model or the discounted cash flow model to go out, get an analysis and understanding of the company cash flows, and then try and work out what the value of that company is. Next, we can look at fairness opinions, which how fair those are is really an oxymoron, specifically when you understand that a lot of the valuations are done by the same companies that are doing the underwriting of the initial public offerings or the secondary market offerings. So they tied together. You've got your fairness opinion being done by the same company, and I personally think that's a conflict of interest. But there's a fairness opinion where you provide your directors of the company with some type of an insurance policy, really, to say that this asset or this merger is fair in the eyes of the shareholder. And then, of course, you give opinions on mergers, acquisitions. You can determine leverage buyout opinions. You can look at the market as a whole. You can go and determine which direction the market's moving. So just an absolute slew of different types of uses of this type of analysis. It's really just left up to the analysts themselves to try and determine what areas they're going to specialize in. But here we're going to just present everything, and you can make your decisions later. So now that you're a portfolio manager, what does the general public look for when they're trying to select a portfolio manager? What it all boils down to really is alpha. I mean, why would someone invest in my fund as opposed to your fund? Well, what they would want to do, of course, is they'd want to have a look at my returns in excess of some benchmark or in excess of the market. This we refer to as alpha. What we mean here is it's the portfolio manager's ability to beat the market indices or to beat the selected benchmarks on a regular basis and provide the investor with an upside that he wouldn't have received were he not to invest in your fund. So there's different ways of calculating alpha. Let's have a look at those. The first we have is the ex-ante alpha, which is really your expected return less of the portfolio, less your required rate of return, and anything that you get in excess here of your required rate of return would be the alpha. This is ex-ante, which means that we're going to actually have a look on a forward basis. But typically what we would normally do is actually have a look at it ex post, which really means historically. So we'll take the actual returns less your required rate of return, and that'll see whether the portfolio manager created any alpha or not. Although this is fun to do, who knows what the market's going to do and what your returns will be. So it's really sort of speculative. This way we've got actually go and see what the historical performance of the portfolio manager is. And of course, ultimately what we want to do is have a risk-reward payoff. As an investor, alpha is great, but you've always got to put it in the perspective of your risk-reward. I mean, it's one thing to invest in a portfolio manager who has a superiorly high alpha. But when you have a major drawdown in that portfolio on a quarterly basis or once every now and again, it can wipe out all that alpha just in one go. So the risk there is potentially outstripping the rewards of the investment. So you've always got to look at this alpha with a risk-reward overlay. Is the risk commensurate with the reward? Does the portfolio manager do a good job of protecting the downside while providing excess upside? So put it in context of risk-reward, or the Sharpe ratio is one measure of risk-reward. And at that point, we've got a good understanding of alpha that the portfolio manager is generating.